Welcome to a new episode on JAP Advisors Ind AS Clinic podcast.
Glad to be here for this one. It's a big topic.
It really is. And I mean, usually when we talk about a diagnostic process, like in medicine, for instance, there's this expectation of absolute clinical precision, right?
Okay, definitely.
Like if a patient breaks an arm, the x-ray reveals this jagged white fracture line.
Yeah, you literally point to it.
Exactly. The doctor points to it, makes the diagnosis, and the path forward is immediately clear. It's binary. It's visible.
Right, and it provides a sense of certainty. I mean, we're naturally drawn to systems that let us categorize complex realities into neat, predictable boxes.
We love the boxes, but
Yeah.
The moment you step out of the hospital and into the realm of corporate finance and accounting,
Oh boy,
right, that x-ray machine suddenly looks a lot less reliable.
a lot murkier.
So much murkier. The diagnostic landscape of financial reporting is famously filled with contracts that seem to say one thing but financially behave like something entirely different.
Which is exactly what we're getting into.
Yes, so today we're taking a massive deep dive into one of those fundamentally vital yet highly misunderstood areas of financial reporting. And I want to speak directly to you, the listener, right at the top of the show here.
Setting the stage.
Exactly, because if you're sitting there thinking, I'm not a corporate controller, I just invest my personal savings into listed stocks.
Right, right here.
Why do I need to spend an hour unpacking deeply technical accounting standards like Ind AS?
I mean, honestly, it's the most important question you can ask, and the answer cuts straight to the core of how capital markets actually function.
How so?
Well, an entity's financial health, its true economic reality, is communicated almost entirely through how it accounts for its financial instruments.
So it's the language of their health.
Exactly. When you invest your hard-earned money in the shares of a listed company, you aren't just buying a brand or a product line.
You're buying the math behind it.
Right, you're buying a proportional slice of their balance sheet. So if a company's investment portfolio or their debt structure is classified incorrectly,
If the x-ray is wrong.
if the financial x-ray is fundamentally misread, it distorts their reported profits. It warps their comprehensive income.
And it artificially inflates or deflates the equity on that balance sheet.
Precisely. And the market reacts to those reported numbers.
Right, because if a classification error forces a company to suddenly recognize massive unexpected volatility in their P&L, the share price is going to swing violently.
It's going to swing hard. The accounting standard isn't just some administrative hurdle for the CFO's office. It's the literal lens through which the reality of the business is presented to the public.
So if you don't understand how the lens works,
You cannot accurately assess the reality of your investment. You're just flying blind.
flying totally blind. So let's calibrate that lens today.
Let's do it.
But before we get into the weeds of today's specific corporate scenario, we need to lay down the ground rules for our analysis.
Very important.
Right. So throughout our discussion today, our functional and presentation currency is the Indian rupee.
Good to clarify.
Any other currency we might touch upon, hypothetically, is considered a foreign currency. Furthermore, our reporting period follows the standard Indian financial year
Which commences on the 1st of April.
and concludes on the 31st of March.
Perfect. And I want to layer an essential point of context over those ground rules, particularly for our international audience.
Oh, right, the IFRS connection.
Exactly. The framework we're dissecting today is Ind AS, specifically Ind AS 109, which governs financial instruments.
But it's broader than just India.
Much broader. There is absolutely no difference between Ind AS 109 and IFRS 9 regarding the specific classification principles we are discussing today.
That's huge.
It is. If you're analyzing a corporate entity, or if you work within an entity following the IFRS framework literally anywhere in the globe, this discussion applies to you directly. The underlying logic is identical.
That makes this a truly global deep dive. Now, let me share the origin of today's specific query, because the source itself is something any finance professional really should have bookmarked.
Oh, absolutely.
We are pulling this scenario from the issue repository on gapadvisors.com.
And we really need to highlight the scale of that repository.
So it's massive.
The site currently hosts over 4,500 highly specific issues and detailed responses.
Wait, 4,500?
Yes, 4,500 plus, covering both Ind AS and Indian GAAP.
That is an unbelievable volume of technical troubleshooting.
Oh, yeah.
4,500 real-world applications.
It's an indispensable resource. I mean, any person can register on the site for completely free, submit their most complex knotted queries regarding Ind AS, or Indian GAAP, and they get a deeply researched, detailed response delivered straight to their email inbox.
That's incredible.
Especially for audit professionals, right? This is a lifeline. When an auditor is staring down an ambiguous application of Ind AS and needs ironclad, standard-backed documentation to justify how they addressed a material issue, this repository provides the precise rationale required.
And today's deep dive is a perfect illustration of that value. The specific query we are unpacking was featured in the 236th edition of the GAAP Advisor's Task Weekly newsletter.
Authored by C.A. Manish-CIR.
Yes, the Director of GAAP Advisors. And it's published directly on LinkedIn. With over 230 editions published to date, it's just a massive archive of knowledge.
So if you are registered on LinkedIn, subscribing to this newsletter is a no-brainer.
Completely free. And if you find your own corporate finance team deadlocked over a highly specific IFRS or Ind AS interpretation, you can actually book a one-on-one consultation with the author himself via his page on topmate.io.
Which is rare, having direct access to someone who spends their life parsing the intent of these standards.
Very rare.
For a corporate treasury or an audit team navigating a high-stakes transaction, that kind of consultation can prevent catastrophic reporting errors down the line.
Absolutely. Now, before we open up the case file, we do have a mandatory disclaimer we must provide.
Of course.
Please note that the views expressed in this deep dive are the personal views of the author of the source material and are not binding on the audience.
We're just exploring the intellectual and technical contours of this accounting issue.
Right. So you are strongly requested to seek the help of a qualified expert before taking or refraining from any action based on the views discussed herein.
Always ensure you have an expert evaluate your specific contractual facts and circumstances.
Okay, disclaimer done. Let's examine the scenario.
Let's jump in.
We are looking at a hypothetical entity, Company A. They're dealing with what I like to think of as the expectation trap.
Oh, that's a good name for it.
Right. Here are the exact facts from the source file. Company A has invested heavily in a corporate bond. The underlying contract dictates that interest is payable annually at a fixed rate.
Simple enough so far.
But there's a crucial caveat written into the term sheet. The bond is explicitly labeled as non-cumulative in nature.
Non-cumulative. In the world of fixed income instruments, that is a highly consequential, structurally dangerous designation for an investor.
It really is. But here's where we run into the friction between human psychology, corporate history, and rigid accounting frameworks.
Which is always where the drama is.
Always. Despite the term sheet clearly stating non-cumulative, Company A's management fully expects to receive regular, uninterrupted interest payments.
Why?
Because they have a long-standing relationship with the issuer. Based on past trends, spanning perhaps a decade, the issuer has never missed a payment. They've always paid out on time. So the CFO of Company A looks at this bond and says, look, I know what the legal document says, but we have 10 years of empirical data showing they always pay.
The old handshake agreement mentality.
Exactly. It's like buying a car based on a handshake versus a written contract. You might expect the dealer to throw in free maintenance because they always have in the past, but if it's not in the contract, it doesn't legally exist.
It's classic conflict.
Hmm.
Management wants the accounting to reflect their operational reality, while the standard setter demands the accounting reflect the legal reality.
And this is where I want to play devil's advocate for a second.
Go for it.
From a business reality standpoint, if Company A has 10 years of historical data demonstrating a 100% payout rate, isn't Ind AS 109 effectively forcing them to report a reality that is actually less accurate to their day-to-day operations?
That's the argument treasurers always make.
I mean, if accounting is supposed to faithfully represent the economics of a business, shouldn't a proven decade-long trend hold some weight over a technical clause that has never once been triggered?
It's a very fair pushback. It really is. But we have to look at why standard setters, like the International Accounting Standards Board, fundamentally reject that argument.
Okay, what do they?
To understand Ind AS 109, you have to remember the context of its creation. It was born out of the ashes of the 2008 global financial crisis.
Ah, right.
Under the older standards, there was a lot more room for management intent and loose expectations to drive classification.
Which didn't end well.
No, it did not. What happened was that companies were holding highly complex, toxic assets, But because management expected them to recover or intended to hold them, they were shielded from the profit and loss statement.
So they were essentially hiding behind their own optimism.
Exactly. When the crisis hit, the market realized that the balance sheets were entirely disconnected from the legal realities of the underlying contracts.
Wow.
So when drafting IFRS 9 and Ind AS 109, the standard setters made a massive philosophical shift.
They shut that door.
They slammed it shut.
Mm.
They determined that expectations and past trends mean absolutely nothing when classifying a financial asset based on its cash flows.
Zero weight.
Zero. The standard is ruthlessly, intentionally objective. It evaluates the worst-case scenario legally permitted by the contract, not the best-case scenario predicted by past behavior.
Because if they allowed expectations to dictate the classification, financial statements would revert to being a reflection of management's subjective hopes rather than hard, enforceable economic rights.
Precisely. Let's look at what non-cumulative actually means mechanically in the real world.
Let's do it.
If a bond is cumulative and the issuer hits a rough patch and misses an annual interest payment, that missed payment is tracked.
It goes on a ledger.
Right. It remains a legal liability for the issuer. They still owe you that money eventually.
Okay.
But if a 500 crore bond is non-cumulative and the specified date for a 40 crore interest payment arrives, and the issuer exercises their contractual right to say, we are skipping this payment,
What happens?
that 40 crore is gone. It vanishes entirely. It does not roll over. You, as the investor, have zero legal right to demand it in the future.
Wow. So it's a permanent evaporation of wealth.
Yes. So the fact that the issuer has paid on time for 10 years is economically irrelevant to the classification test because the contract gives them the unconditional right to inflict a permanent loss of cash flow on the investor tomorrow.
And the accounting must reflect the existence of that right. Okay, so management's expectations are entirely stripped from the equation. We're operating strictly within the four corners of the legal contract.
Only the contract.
This brings us to the core mechanism of the standard. The source file asks whether this non-cumulative bond satisfies the SPPI and Contractual Cash Flow Test, commonly referred to as the CCFT.
The big gatekeepers.
Yeah, let's demystify these acronyms. What exactly is SPPI? It sounds like a secret password to a club.
It kind of is.
Right. Why is the solely payments of principal and interest test the ultimate bouncer at the club of accounting classification?
Well, think of the Contractual Cash Flow Test, not just as a gatekeeper, but as a genetic sequencer for financial instruments.
Okay, I like that.
The standard wants to look at the foundational DNA of the contract.
Okay.
SPPI stands for solely payments of principal and interest.
It's solely.
Yes, solely. For a financial asset to qualify for the more stable, predictable accounting methods like amortized cost, its cash flows must pass this genetic test. They must consist solely of principal and interest.
But wait, interest is a massive loaded term in finance, isn't it?
It is.
I mean, you can have interest rates tied to the London Interbank offered rate. You can have them tied to the price of Brent crude oil, or even tied to a company's carbon emission targets these days.
Very true.
How does Ind AS 109 define what acceptable interest actually is?
That is the exact question the standard answers in paragraph B4.1.7a. It introduces the concept of a basic lending arrangement.
Basic lending arrangement.
Right. When you strip away all the complex Wall Street financial engineering, the derivatives, the embedded options, what is a basic loan?
Just giving someone money and getting it back with a little extra.
Exactly. It's an arrangement where you provide funds to an entity, and they promise to return those funds, plus a specific type of compensation.
The interest.
The standard dictates that in a basic lending arrangement, this compensation, the interest component of SPPI, must primarily consist of just two things.
And they are.
Consideration for the time value of money and consideration for credit risk.
Okay, let's dissect both of those. Because while they sound like introductory finance concepts, the way Ind AS 109 applies them is incredibly rigorous.
Oh, incredibly rigorous. Let's start with credit risk, which is the more intuitive of the two.
Makes sense.
Credit risk is simply the risk that the borrower defaults and does not pay you back.
Right.
So if you are lending to a highly stable, AAA-rated sovereign government, your credit risk is low.
So the interest rate premium you demand is low.
Exactly. But if you're lending to a distressed tech startup, the credit risk is high, so the premium must be significantly higher. That is a fundamental acceptable component of SPPI.
It's direct compensation for the probability of loss.
Exactly. But the time value of money is where the standard gets mathematically philosophical.
Mathematical philosophy, I love it.
Right. The time value of money is the macroeconomic principle that a rupee in your hand today is intrinsically worth more than a rupee promised to you 5 years from now.
Because I have opportunity cost. If I have the rupee today, I can deploy it. I can build a factory, I can invest it in the market. Furthermore, macroinflation means that a rupee today has more purchasing power than a rupee in 5 years.
Exactly right.
By lending the money out, I'm sacrificing current utility and exposing myself to inflationary degradation.
You've got it. The interest you charge in a basic lending arrangement must compensate you for the mere passage of time.
Okay.
So, why does Ind AS 109 demand that the genetic sequence of the bond be solely these elements? Let's say a company issues a bond, but to lower their interest rate, they include an equity kicker.
And the equity ticker.
Yeah. The contract says, we will pay you 4% interest, but if our stock price doubles, we will pay you 8%.
I mean, from a business perspective, that happens all the time. It aligns a debt holder with the equity growth of the company.
It does. But look at it through the lens of SPPI.
Mm-hmm.
Is that 8% payment compensating the lender for time value of money?
No.
Is it compensating them for credit risk?
No, it's not.
No. It's compensating them for equity performance. The genetic sequence of the instrument has been altered. It is no longer a basic lending arrangement. It's a complex, volatile hybrid instrument carrying equity risk.
And if it carries equity risk, it fails the SPPI test.
Exactly. And failing the SPPI test has severe consequences.
This is the bouncer kicking you out of the club.
It forces the instrument to be measured at fair value through profit or loss, or FVTPL.
Let's hover on FVTPL for a second because I want the listener to understand why CFOs lose sleep over this.
It's a nightmare for them.
If a bond is measured at FVTPL, it means that every single reporting period, the company has to look at the open market, determine what that bond is worth today, and if the value has dropped.
Even if they have no intention of selling it.
Right. They have to take that loss directly against their net income.
Correct. If interest rates in the broader economy shift, the fair value of the bond shifts. If it's FVTPL, those shifts hit the P&L immediately.
It introduces massive, uncontrollable volatility into the company's reported earnings.
And analysts hate volatility. It makes forecasting impossible.
Which hurts the stock price.
Exactly. That is why corporate treasurers are desperate to structure their bonds to pass the SPPI test, so they can use amortized cost, which ignores market fluctuations and just steadily recognizes the interest over the life of the bond.
Okay, so that establishes the stakes. SPPI is the genetic test, and time value of money and credit risk are the only acceptable markers.
Yes.
This brings us to a really fascinating intersection of abstract accounting theory and rigid mathematics, specifically regarding delayed payments. Let's scale up an example to show how this works in a corporate setting.
Sounds good.
Imagine a corporate treasury buys a massive 500 crore rupee bond. It's a 5-year term, yielding 10% annually.
Okay, standard.
So the issuer is supposed to pay 50 crores in interest every year. But let's say the issuer hits a liquidity crunch in year 1.
It happens.
They don't default, but they utilize a clause in the contract that allows them to defer that 50 crore payment until year 2. Now, if they just hand over that 50 crores a year late without paying any additional penalty or interest on the delay, the Treasury hasn't just been inconvenienced. They've suffered a massive, quantifiable economic loss, haven't they?
They have suffered a profound loss.
Right.
That 50 crore payment was supposed to be in the Treasury's hands at the end of year 1, ready to be reinvested or used to fund operations.
But it wasn't.
By delaying the payment, the issuer has essentially forced the Treasury to provide them with a 50 crore interest-free loan for a year.
A free loan.
The issuer received the benefit of the time value of money on that 50 crores, and the Treasury receives zero compensation for it.
Wow.
This exact scenario is where paragraph B4.1.7a of Ind AS 109 shows its teeth.
So if I'm an auditor looking at this 500 crore bond contract, and I see a clause that allows for deferral, what specifically am I looking for to ensure it doesn't fail the SPPI test?
You're looking for compound interest.
Compound interest.
Yes. The standard states unequivocally that for the contractual cash flows to qualify as a basic lending arrangement, the instrument must provide interest on unpaid interest.
Wait, really? The standard explicitly demands compound mechanics.
It does.
If a contract uses simple interest on a delayed payment, it invalidates the whole thing.
Let's break down the mathematical reality of simple versus compound interest to understand why the standard setter drew this hard line.
Please do.
Simple interest only calculates the return on the original principal amount. In your 500 crore bond example, simple interest means the meter is only running on the 500 crores. It
Oh.
generates 50 crores a year, period. If the issuer defers the year one payment, simple interest dictates that in year two, they just owe the year one 50 crores plus the year two 50 crores.
So the missed 50 crores just sits there, inert. It doesn't generate its own return.
Exactly. But compound interest recognizes the continuous nature of the time value of money.
Continuous.
Yes. The moment the 50 crore payment is missed, it mathematically becomes part of the principal balance owed.
Mm.
So going into year two, the Treasury is no longer lending the issuer 500 crores. They are effectively lending them 550 crores.
So the base changes.
Compound interest dictates that the 10% rate must now apply to that new total. You must charge rent on the delayed rent.
Because if you don't charge rent on the delayed rent, you're providing a free service.
Precisely. And this is where the source text we are analyzing today drops the hammer.
What does it say?
The text explicitly states, if the bond accumulates interest as specified in the contract on a simple interest basis and not on a compound interest basis, that is, no interest is paid on the unpaid interest,
The bond fails.
the bond does not provide consideration for the time value of money.
That is a staggering implication for corporate structuring.
It changes everything.
If I'm understanding this correctly, you could have a beautifully drafted standard corporate bond, but if there is a single clause buried in an appendix that allows for a payment delay structured on a simple interest basis, it corrupts the entire genetic sequence of the bond.
It does. Completely.
Unbelievable.
Because Ind AS 109 views the time value of money as an unbroken continuous force. It doesn't pause just because a borrower misses a due date.
The clock keeps ticking.
Always. If the legal contract allows the borrower to halt the compensation for time value without penalty, then the overall return of the bond is no longer solely compensating for time value and credit risk.
It's being watered down.
It is being artificially depressed by a structurally flawed payment term. The SPPI test identifies that simple interest mechanism, recognizes that it ignores the continuous nature of time, and fails the bond.
That is incredible, and it perfectly sets up the specific dilemma Company A is facing with their non-cumulative bond.
Back to Company A.
Right. We've established that simple interest fails the test. But Company A's bond doesn't even use simple interest on delays. It's non-cumulative. It wipes the delay out entirely.
Which brings us to a vital principle in accounting: substance over form.
Substance over form.
The economic reality of the contract always overrides the marketing label slapped on the cover page.
Let's apply that to Company A. The bond is labeled non-cumulative. Based on the rigorous logic we just built around the continuous nature of time value, does it automatically fail?
Let's follow the cash flows.
Okay.
A non-cumulative bond means that if the issuer exercises their right to skip the interest payment on the specified date, that cash flow is canceled. It evaporates.
Poof, gone. The issuer gets to hold the 500 crore principal for another year and pays absolutely nothing for the privilege.
Correct. So we ask the genetic question, does that contract provide cash flows on specified dates that are solely payments of principal and interest?
No.
No, it contains a term that can arbitrarily erase the interest component entirely. The time value of money is completely ignored because the return on the passage of time can just be zeroed out at the issuer's sole discretion.
So it's an automatic fail.
Therefore, an inherently non-cumulative bond utterly fails the contractual cash flow test. It does not meet SPPI.
But in the world of corporate finance, there are always exceptions, complex carve-outs, bespoke structuring. Are there any loopholes where a non-cumulative bond could somehow survive the SPPI test?
Actually, the source file mentions one highly technical, mathematically complex exception.
Oh.
A non-cumulative bond can pass if, and only if, the final redemption happens at a premium that specifically and perfectly compensates the holder for the time value of money that was lost during the skipped payments.
How exactly would that work in practice? If the issuer can skip payments, how do you build a premium that fixes it?
It requires meticulous contractual algebra. Let's return to our 500 crore bond. It's a 5-year term, yielding 10% annually. It is non-cumulative.
Okay.
Year 1, the issuer skips the 50 crore payment. Year 2, they skip it again. Years 3 and 4, they pay the 50 crores. Now we arrive at maturity in year 5.
A day.
To pass SPPI, the contract cannot just say, here's your 500 crore principal back. It must contain a mandatory clause stating that upon redemption, the principal must be increased by a calculated premium.
And that premium cannot be an arbitrary number, right?
It must be mathematically calculated to recreate the exact compound interest curve of the missing 50 crore payments from year 1 and year 2, stretching all the way to year 5.
So it acts as a retroactive, compounded makeup payment built into the terminal value of the bond.
Exactly. The overall macro substance of the contract still guarantees that the investor receives full consideration for the time value of money, even if the timing of the interim cash flows was disrupted.
That's a clever workaround.
But I must stress, this is incredibly rare. Absent that specific, legally binding mathematical premium at redemption, a standard non-cumulative bond is dead on arrival for SPPI.
Okay, I track that logic perfectly. But let's flip the script, because this is where I think a lot of standard finance professionals get caught in what we can call the label trap.
The label trap, yeah.
What if Company A had realized non-cumulative was dangerous, so they specifically went out and bought a bond that was explicitly legally named cumulative? Shouldn't an auditor just look at that label, assume it safely stacks up all missed payments, and pass it through the test?
Trusting the label is the most dangerous assumption an auditor can make. You cannot blindly assume a cumulative bond passes SPPI.
But why?
The nomenclature on the cover page is economically meaningless.
If the bond is cumulative, it means my missed payments aren't evaporating, they're being saved for me. Doesn't that solve the non-cumulative problem?
It solves the evaporation problem, but it doesn't solve the time value problem. We have to go back to our discussion on simple versus compound interest.
Oh, right.
How mathematically does the bond accumulate? The source text from Gap Advisors is crystal clear on this. Whether a bond is cumulative or non-cumulative is not the sole factor.
Okay.
If the bond accumulates interest as specified in the contract on a simple interest basis, the bond does not provide consideration for the time value of money.
Ah. So even if the bond is proudly titled cumulative and it dutifully stacks up my missed 50 crore payments in a ledger, if the contract doesn't force the issuer to pay interest on that growing stack of missed payments,
You're just hoarding my simple interest.
I am still bleeding out from opportunity cost. I am still losing the time value of money on the delay.
You have nailed it. A cumulative bond that operates on simple interest completely fails the contractual cash flow test.
Wow.
It is just as disqualified as the non-cumulative bond. It fails the genetic sequence test.
That is just, it's a massive trap.
This is precisely why auditors, and this is where utilizing a deep technical resource like the gadvisors.com repository becomes critical, must read the fine print.
They can't just skim it.
They cannot look at the term sheet, see the word cumulative, and rubber stamp an amortized cost classification. They have to dig into the actual Excel formulas embedded in the contract's appendices.
And ask what?
Does this specific compounding mechanism adequately and continuously compensate the lender for the time value of delayed cash flows?
It is wild to think about the sheer scale of the consequences here. You could have a multi-billion rupee corporate balance sheet and millions in reported equity hinging entirely on whether a junior lawyer drafting an appendix used a simple interest formula instead of a compound interest formula.
It's the literal difference between a stable, predictable balance sheet and a highly volatile income statement. The devil is truly in the mathematical details.
Which brings us to the final destination of Company A's query. They didn't just ask about SPPI.
Right, there was more.
They specifically wanted to know if they could classify this non-cumulative bond as an FVTOCI debt instrument.
FVTOCI.
FVTOCI stands for Fair Value Through Other Comprehensive Income. Now, let's unpack this classification because it's the holy grail for a lot of corporate treasuries.
It really is.
Let's assume, just for a moment, that we have a magical bond. It's cumulative, it utilizes flawless compound interest, it compensates for time value and credit risk perfectly.
A unicorn bond.
The genetic sequence is pristine. It passes the SPPI test with flying colors. Are we done?
Right.
Does Company A automatically get their desired FVTOCI classification?
Not at all. Meeting the contractual cash flow test, passing SPPI, is only 50% of the battle.
Only 50.
And AS 109 establishes a rigorous two-part gating mechanism under paragraph 4.1.2a. The SPPI test we just spent all this time dissecting is technically condition B. We haven't even addressed condition A yet.
Okay, so SPPI is the genetic test. What is condition A?
Condition A is the business model test.
Business model test.
The standard states that a financial asset is measured at FVTOCI if it is held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets.
That "and" seems to be doing an incredible amount of heavy lifting.
It is the fulcrum of the whole thing.
Let's look at this from the perspective of a corporate treasury department. Why does a treasurer care so much about that "and"?
To understand why, let's contrast it with the alternative. If a company's business model is purely to buy standard bonds, hold them strictly until maturity, and just passively collect the principal and interest over 5 or 10 years.
So they have absolutely no intention of trading them on the secondary market.
Exactly. That is a pure held-to-collect business model. If an instrument passes SPPI and sits in a held-to-collect model, it is measured at amortized cost.
Which means the bond just sits on the balance sheet, steadily realizing interest income, completely ignoring the noise of the open market.
Exactly. It's stable, but it's rigid.
Right.
But corporate treasuries rarely want to be that rigid. They are managing active liquidity pools.
So what do?
What if they want to hold these 500 crore bonds to collect the reliable interest, but they also need the strategic flexibility to sell them?
Like if things change.
Maybe the yield curve shifts dramatically and they want to lock in a capital gain. Or maybe the broader business suddenly needs a massive injection of cash for an acquisition, and the treasury needs to liquidate the portfolio.
That is a held-to-collect and sell business model.
They have dual objectives. They want the yield, but they demand the liquidity.
Precisely. And because they are realizing value through both methods, passive collection and active sales, the accounting framework must reflect both realities. Well, because they might sell the bond tomorrow, the balance sheet must reflect the fair market value of the bond. However, if they ran all those daily fair value fluctuations through the P&L, it would cause earnings chaos.
Right, the volatility problem we discussed earlier, analysts would hate it.
So FVTOCI provides a brilliant compromise.
The shock absorber.
Yes. The asset is carried at fair value on the balance sheet, but the unrealized gains and losses from market fluctuations are parked in a special reserve in equity called Other Comprehensive Income, or OCI.
It acts as a shock absorber.
The noise is kept out of the net income until the bond is actually sold, at which point the realized gain or loss is recycled into the P&L.
So the and sell component of the business model is the specific trigger that allows a company to use this FVTOCI shock absorber.
Assuming the bond already passed the SPPI test.
Correct. Both conditions, the business model and the FPPI test, must be met independently. It is an absolute and-e statement in the standard.
So let's bring it all back to Company A's specific reality.
Or Company A.
They're holding a non-cumulative bond. They are desperately hoping their 10-year trend of getting paid will save them. They want the FVTOCI classification to protect their P&L from volatility. Based on the entire architecture of Ind AS 109 that we've mapped out today, what is the final, inescapable verdict?
The verdict is definitive, and it is harsh, because Company A's bond is inherently non-cumulative, and assuming it lacks that incredibly rare, mathematically perfect redemption premium.
Which they almost always do.
Right. It fundamentally fails the contractual cash flow test. Its genetic sequence is corrupted because it ignores the time value of money. It fails condition B.
The DNA test rejected it before it even got to the business model evaluation.
Exactly. Because it fails the SPPI test, the business model is entirely irrelevant.
Wow.
It does not matter if Company A's treasury has perfectly designed a hold to collect and sell operation. The instrument itself is disqualified.
So they are out of luck.
Therefore, Company A cannot, under any circumstances, classify this bond as FVTOCI. It will be forced into the fair value through profit or loss category, bringing all of that uncontrollable market volatility directly into their reported net income.
It's a brutal reality check, but it's a reality grounded entirely in the objective text of the legal contract, completely immune to the optimism or historical expectations of the investor.
You can't count on hope.
You really can't. This has been a masterclass in the mechanics of Ind AS 109, and it brings us to a broader philosophical point to wrap up this deep dive.
Let's hear it.
We have spent an hour dissecting the mechanics of one very specific type of non-cumulative bond. But the underlying principles we've discussed today have a massive ripple effect across the entire financial ecosystem.
They absolutely do. There's one overarching concept I want the listener to ponder long after this deep dive ends. It's the absolute supremacy of substance over form in financial reporting.
Like substance over form.
We have demonstrated today that the label cumulative does not guarantee it actually protects time value. The label non-cumulative destroys its status as a basic loan. I challenge you, the listener, to look at the financial architecture around you.
Apply it to everything.
How many other corporate assets, massive structured contracts, or even personal investments in your own portfolio are fundamentally misunderstood because the market trusts the label on the tin instead of rigorously calculating the actual mechanics of the cash flows?
That is a deeply unsettling thought.
It should be. Think about corporate preference shares. They're called shares, they sit in the equity section, but depending on the mandatory dividend clauses, they might mathematically act exactly like hard debt.
Right.
Think about massive real estate leases that are labeled operating leases to keep them off the balance sheet, but in substance, they transfer every single risk and reward of ownership to the lessee.
It's everywhere.
When you grasp the ruthless, logical framework of standards like Ind AS 109, it fundamentally upgrades how you read a prospectus. It forces you to view every single financial statement with a healthy, forensic level of skepticism.
You stop asking, what is this instrument called?
And you start demanding to know, how exactly does the cash move? Understanding that difference is a superpower in the world of finance.
How exactly does the cash move? That is the ultimate diagnostic question and the only reliable X-ray in corporate finance.
Perfectly said.
We want to profoundly thank you, our audience, for dedicating your time to this deep dive today. Wrestling with these abstract, highly technical concepts is demanding, but as we established at the beginning of the show, understanding this invisible machinery is absolutely crucial if you want to truly understand where your capital is going and the risks it is exposed to.
Deep technical knowledge is the single best hedge against financial risk.
Without a doubt. Before we sign off, we have a few important requests to help you continue building that knowledge. First, please take a moment to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts.
Highly recommend it.
We are available on Spotify, Amazon Music, and YouTube, so whichever platform you prefer to listen to your podcasts on, make sure you hit that subscribe button so you never miss an analysis.
And for real-time, actionable updates, you must follow the Gap Advisors Ind AS Clinic channel on WhatsApp.
It's so fast.
In today's regulatory environment, speed is critical. The WhatsApp channel is the fastest way to get instant alerts on all our new videos, deep dives, newsletters, complex issues responded to on the repository, and critical breaking news on new standards issued by the regulatory bodies.
Yes, having that information pushed directly to your phone is incredibly convenient. Finally, we have a massive favor to ask.
Please share this.
Yes, please share this deep dive among your professional contacts, your colleagues, and your corporate audit and finance teams. If you know a corporate treasurer wrestling with asset classification, send this to them.
It could save them a lot of trouble.
And especially, please share this with students pursuing their CA course. Academic textbooks can only take a student so far.
They need the real-world application.
Truly understanding the real-world application of Indian accounting standards, the philosophical intent behind the rules, and the hidden traps like the simple interest cumulative bond we unpacked today, that is the transition from a student to a true financial expert. Help us spread this critical knowledge to the next generation of professionals.
The standard-setting environment is only going to get more complex. The next generation needs to understand exactly how to navigate these murky waters with precision.
Well said. We started this conversation talking about broken diagnostic machines and murky corporate realities. I think today we managed to repair the lens and get a crystal clear picture of what is truly going on inside these contracts.
I agree.
Thank you for joining us in the clinic. Keep questioning the labels, keep relentlessly calculating the cash flows, and we will see you on the next deep dive.